It's now 9.9, just very close. Some problems, however, are more serious in this instance. If you look first at next at the middle clip here, you see 44% of the unemployed have been out of a job for 27 weeks or more, far worse than ever before. So long-term unemployment is far, far worse in this economic cycle than it has ever been. And if you look at the top clip, most discouraging is that more than half of the unemployed are not on temporary layoffs. Their jobs have been eliminated, and this is also worse than ever before. So these are eliminated jobs. That's going to be a lot tougher to get that group back into the workforce. The dire unemployment picture is putting heavy pressure on wages, as seen on the next page. At year end, manufacturing unit labor costs, which you see vaguely down here in this lower corner, were down 6.6% from the year before. Now that's the biggest drop in more than 60 years. Inflation is unlikely when there's that kind of downward pressure on wages. And while the unemployment problem is weighing heavily on wages, the government has stepped in to keep income from collapsing, which you see over on page 20. The bottom half of the graph shows the path of inflation-adjusted disposable personal income without government transfer payments. Clearly a downward trend. The top half shows that while down from its peak up here, government transfers have kept disposable income from plummeting. So we see it's not as high as it was at its best, but it's nothing like what it would be without government transfers. And such transfers certainly will slow soon as the stimulus is fully paid out and ultimately is stopped. So the consumer is unlikely to buy aggressively unless the employment picture brightens considerably. And that's certainly not an inflationary tendency. Right now, and there is a lot of competition because there's another statistic called the U6, which is getting a little esoteric, but essentially it's the unemployed not seeking a job and the underemployed, people working far less than they would like to be working if they had their druthers. And that figure, I didn't even hear the number this morning, but I heard it ticked up again. So you've got something in excess of 17% of the population is either unemployed or underemployed. That's a lot of weight pushing down on inflationary pressures. Inflationary pressures are tough to produce if you've got large amounts of unemployment. We read a lot about banks having received huge amounts of rescue money. That's the credit inflation that I talked about earlier. Yet they're not lending. And you see over on the next page, loans in the money supply are collapsing. We see the decline in bank lines at the bottom of the graph in red. It's the worst in half a century. Part of the problem, and you can see here it's boom, worse in half a century. Part of the problem is the banks want to keep that money on their own books because they want to keep their reserve ratios high. They're afraid, they know they've got a lot of bad debts still in their pipeline. They want to keep that money to keep the reserve, to keep the ratios up. The creditworthiness of the potential borrower is obviously somewhat less than it was a year and a half to 2 or 3 years ago. The recession has taken a toll on the creditworthiness of the average borrower. So the average person coming to the bank is not as creditworthy as before. But then, interestingly enough, the demand for bank loans has declined very substantially. It's fallen at the greatest rate in the past half century. So it's not just that the banks are unwilling to lend. There aren't as many people knocking on the door. You can also see in the middle clip that the growth in the M2 money supply has contracted substantially. It's not at the bottom, ultimate bottom, but you've seen that the rate of increase in M2 has contracted very substantially. And these factors both work against business growth and tend toward deflation, not inflation. Page 22 shows that the money supply in the Eurozone is at its most sluggish in more than 40 years, also deflationary. So money growth, and M3 is even broader than our M2. Interestingly enough, the Fed decided they didn't want to publish the M3 for us anymore about, I forget, a year and a half, 2 years ago, something like that. And a lot of people who, and I don't even know what they're called, it's like kind of the shadow Federal Open Market Committee, but there are shadow money market observers, and they hypothesize what M3 would be. And they say, if we had M3 reported, it would look like the European M3. The money supply is not rising rapidly, which is a depressing effect on business and in turn then on prices. A co-star in the deflationary drama, along with the severe unemployment problem, is the horrible housing crisis, obviously. The massive overhang of housing inventory will likely keep downward pressure on housing prices for some time to come. On page 23, you could see one of the effects of so many vacancies, falling residential rates. And this statistic has a heavy weight in the Consumer Price Index, the CPI measure of inflation. Now, most recent observations, and I haven't seen a graph of it, have shown a slight uptick in residential rates, but this factor will continue to weigh against inflation, at least in the short run, especially as government stimulus slows and stops. And another factor working against inflation is excess manufacturing capacity, which you can see on page 24. The bottom clip shows that we're employing far less than normal levels of capacity, which is a deflationary force. This is another of those statistics that show rate of growth good. Notice here in the middle clip, rate of growth in capacity utilization is up in the normal range. Level of capacity utilization is extremely low. That is very, very typical. If you just saw, as I do every week, I see many dozens of these economic and market graphs. That's a typical pattern. Growth rate, great. Level, not good. We see another deflationary force on page 25. State and local government budgets are in shambles. You've probably read an awful lot about that as well as I. This graph shows clearly how their spending has plummeted. And at the national level, the federal budget deficit is in its most deflationary position ever, over on the next page. That deflationary pressure will not be alleviated soon because we've got massive budget deficits as far as the eye can see. So deficits have, over recent decades, been somewhat disinflationary at least. The question is, when they get this severe, will they be deflationary? We won't know, but that's at least the tendency. And then there's Greece. On the next page, you see how much of its debt has been distributed. This is a graph, and it's not terribly clear, but I think you can make out the numbers and words. This graph shows how widely spread Greek debt is throughout the Eurozone. It helps to explain why so many countries are expressing a willingness to play a role in the proposed bailout. It's not out of a great desire to